Okay, so picture this. You and your partner finally hit that milestone. You've got, I don't know, 100 grand sitting in the bank,
A very nice problem to have.
right? And you decide to do the responsible thing. You're going to put it all into a basic, boring index fund. Like just track the S&P 500 and let it ride. So you look at Fidelity and you look at State Street. They both hold the exact same companies, so it doesn't matter which one you pick, right?
Well, actually, that specific decision, picking one over the other, over 30 years, it could literally mean the difference between ending up with $500,000 more or $500,000 less in your retirement account.
Okay, I need a second. 500,000 from the exact same stocks?
The exact same stocks.
I'm Lynn.
And I'm Frank. Welcome to Talk and Wonder. We create easy-to-understand whiteboard animations covering family finance, investing, passive income, and debt management.
Our goal is to break down complex financial topics, help you avoid traps, and build wealth together. If you want to secure your future, you are exactly in the right place.
So before we get into the actual numbers, and trust me, the math gets wild today, we need to quickly clear up what a fund actually is, because, well, that's the foundation of everything.
Because if you're like me, you hear index fund and ETF, and your brain just kind of tunes out.
Fair. Look, an index fund is basically just a basket of stocks. Instead of trying to guess if, say, Apple or Amazon will win, you just buy the whole basket.
Right. Your risk is spread out. No expensive money managers day trading your family's future away.
Exactly. Now, here is where Fidelity and State Street took two completely different paths. Fidelity built most of their index lineup as mutual funds. State Street built theirs as ETFs.
Okay, wait, does that actually matter? Because they sound like two ways of ordering the exact same coffee.
That's actually a pretty good way to put it. The main difference is how you buy them. Mutual funds, their prices are set at the end of the day. ETFs trade all day long, just like regular stocks. But what's inside the cup, the actual companies your money goes into, nearly identical.
So why the huge gap in returns? Is it the history of the companies?
It plays a part, yeah. Look at Fidelity, founded way back in 1946. They built their massive, like over $6 trillion empire on smart stock picking. But today, they compete aggressively on fees. They were literally one of the first to offer zero expense ratio funds.
Zero fees. That's the dream for any family budget.
Right? But then you have State Street. They've been around since 1792, but their big moment, the thing that changed the world, happened in 1993.
Wait, 1993, wasn't that the first ETF ever?
Bingo. After the 1987 Black Monday crash, people were terrified. State Street answered by creating SPY, the very first ETF listed in the U.S. They didn't invent index investing, Vanguard did that, but State Street made it tradable in seconds.
So Fidelity competes on dirt cheap fees, and State Street competes on instant access.
Exactly. Two different philosophies. But which one actually grows your money better? Let's start with the one thing every family hates paying. Let's start with fees, because over 10, 20, or 30 years, a tiny gap in costs can, well, it snowballs into thousands of dollars lost.
It's like those sneaky little app subscriptions, You think, oh, it's just $2 a month, but then...
Then you realize you've been paying for a meditation app you never use for 5 years?
Exactly. We literally did that. It quietly drains the account.
Right. So for basic buying and selling, both Fidelity and State Street are commission-free. But the management fees, the expense ratios, that's where they split. For the S&P 500, Fidelity's FXAIX charges just 0.02%. State Street's SPY charges 0.09%.
Okay, so State Street is, well, more than 4 times as expensive.
Yep. And for the total market, Fidelity's FSKAX charges basically 0.02%, while State Street's SPTM is 0.03.
So Fidelity is the clear winner for the household budget.
For the core funds, absolutely. Now, State Street does fight back. Their dividend fund, SPYD, and international fund, SPDW, are actually a tiny bit cheaper. But when you line them all up, Fidelity wins where it counts most for everyday investors. Plus, zero account fees, no minimums. So round one, Fidelity takes it.
Confident. 1-0. Makes sense. I mean, lower fees mean we keep more of our own money. So if we just buy the cheapest one, we win, right?
You would think so, but let's look at round two, the actual growth, starting with the benchmark everyone uses, the S&P 500.
Right, the 500 biggest U.S. companies. Apple, Nvidia, Microsoft.
Exactly. So we put our $100,000 into Fidelity's FXAIX and another $100K into State Street's SPY. Now, SPY has it has a weird quirk. Because it's so old, it's structured as a unit investment trust.
Which means what exactly? Because it sounds complicated.
In plain English, it means SPY actually cannot reinvest its dividends right away. It has to hold them as cash until it distributes them to investors. Newer ETFs don't have that limitation.
Wait a minute. So State Street charges us 4 times more in fees, and it has a structural disadvantage where our money just sits there doing nothing?
On paper, yes, it looks like an easy, guaranteed win for Fidelity. But let's look at the 30-year math. For Fidelity's FXAIX, after 30 years, that $100,000 grows to $3,681,103.
Okay, over $3.6 million. Honestly, not bad for just setting it and forgetting it.
Right? It's a huge number. But SPY, over 30 years, it hits $3,838,190.
Frank, stop. Are you serious right now?
I am completely serious.
It makes more? How? That's roughly $157,000 more.
Exactly. SPY had a slightly higher average share price appreciation, 12.45% versus Fidelity's 12.3%. And that tiny, tiny difference in pure growth, it just completely swallowed the higher fee and the weird dividend structure.
So the more expensive, older fund actually leaves our family with an extra $150,000. That is honestly kind of maddening. It goes against everything we're taught about budgeting.
It breaks the rule, right? So State Street takes round two. The score is tied 1-1. But look, the S&P 500 only covers 500 companies.
Which is just the top of the food chain. What about all the medium and smaller companies out there?
Exactly. That brings us to round three, the total market. Because, the U.S. stock market has thousands of other companies, mid-size, small ones, names most people have never even heard of.
Right, but they're still growing. I mean, every giant company started as a small one at some point.
That's the theory. A total market fund tries to capture all of it. Imagine zooming out from just looking at the big downtown skyscrapers and buying a piece of the entire city.
Okay, that sounds like a solid strategy for a family portfolio. You don't want all your eggs in just the tech giant basket.
Yep. So Fidelity's version is FSKAX. It tracks roughly 100% of the investable U.S. market. If it's publicly traded in America, FSKAX probably owns a piece of it. It holds nearly 3,800 stocks.
Wow, 3,800. That is a lot of companies to keep track of.
It is. Now, State Street's version is SPTM, but they do it differently. They track the S&P Composite 1500 index, so it's the S&P 500 plus 400 mid-cap plus 600 small-cap companies. That's it. It holds about 1,500 stocks.
Wait, so Fidelity holds more than double the number of stocks that State Street holds?
More than double.
Well, based on normal logic, more coverage means more diversification, and more diversification means better returns, right? We literally just said we wanted to own the whole city.
You would think. I mean, it's a very logical assumption, but let's run the $100,000 test again. After 30 years, Fidelity's FSKAX, the one with 3,800 stocks, grows to $3,326,108.
Still over $3 million. Pretty good.
Now, State Street's SPTM, the one with only 1,500 stocks, after 30 years, it hits $3,768,629.
Okay, I need to do the math. That is roughly a $442,000 difference.
In State Street's favor, yes.
But how? Fidelity had 2,300 more companies. Did those extra 2,300 just do nothing?
Actually, it's worse than nothing. They added noise without adding returns. Most of those extra 2,300 are tiny stocks at the very bottom of the market. They're highly volatile.
So it's like buying a giant bucket of mixed candy, but half of it is those weird black licorice ones nobody wants.
Exactly. State Street's tighter focus filtered out the smallest, riskiest names. It kept the strong, mid, and small cap companies, but threw out the junk. And that discipline paid off big time.
So the lesson here is more isn't always better. Sometimes trying to own absolutely everything actually drags down the family net worth.
Right. It cost them nearly $500,000 in growth. So round 3 goes to State Street. Score is Fidelity 1, State Street 2. State Street takes the lead.
Okay, but these first rounds have all been about the distant future, like building a massive account for when we're old and gray.
Which is important.
It is. But you know what else is important? Paying the mortgage next month. What about funds that actually put cash in our pockets right now?
Now we are talking about dividends. Round 4. And this is where the matchup gets, well, it gets really fascinating because these two funds approach paying you in completely different ways.
Okay, break it down for me. Fidelity versus State Street. Who's bringing home the bacon?
Let's look at Fidelity first. Their pick is FDVV. Now, the name literally says high dividend. But if you look under the hood, the top 3 holdings are NVIDIA, Apple, and Microsoft.
Wait, what? Those are tech giants. Do they even pay dividends? I thought they just reinvest everything into, like, AI and new iPhones.
Exactly. They barely pay dividends. But Fidelity weights the stocks by market cap. So, because those tech companies are so massive, they end up dominating the fund. It's basically a dividend fund with a massive tech engine hiding underneath.
Okay, sneaky. So what about State Street?
State Street's pick is SPYD. Completely different approach. They take roughly 80 of the highest yielding stocks in the S&P 500, and they just give them all equal weight. No tech dominance. The biggest sector is real estate, then utilities. Technology is only like 2% of the fund.
Okay, I like that. SPYD sounds like it's built to actually pay the bills, not just ride the tech wave.
It is. So let's run the $100,000 through the 30-year machine. With Fidelity's FDVV, the one with the tech engine, that $100K grows to $1,903,063.
Nice, almost $2 million.
But, and here's the catch, the monthly income generated by year 30 is projected at $1,376.
1,300? Frank, that doesn't even cover our kids' daycare, let alone the mortgage. What about State Street's SPYD?
All right, SPYD. Remember, no tech engine. Over 30 years, the total account value only reaches $1,340,950.
Oh, that's a huge drop. That's over $500,000 less in total net worth compared to Fidelity.
It is a $562,000 gap in total value, even with State Street paying you $6,000 a month. It would take years of that extra income just to close the gap. You could always just sell a tiny piece of the Fidelity account if you needed cash.
Okay, fair point. The math doesn't lie, even if my heart wants that monthly paycheck. So Fidelity wins round 4 on sheer account size.
Correct. So the scoreboard is now tied again. Fidelity 2, State Street 2. It all comes down to the final round. And so far, we've only been looking inside the U.S. Right. The world doesn't stop at the U.S. border. Some of the biggest companies our family buys from, like, Samsung, Nestle, Toyota, they're all international.
And if we want to build a truly bulletproof retirement, we probably shouldn't ignore the rest of the planet.
Exactly. So the tiebreaker, international funds. Fidelity brings FSPSX. It covers 21 developed countries. It holds about 703 stocks, and the fee is crazy low, 0.04%.
Okay, 21 countries, 700 stocks, low fee. Sounds like the classic Fidelity playbook.
It is, but it has a blind spot. The specific index Fidelity tracks, it completely excludes Canada and South Korea.
Wait, what? No Canada? But Shopify is Canadian and Samsung is South Korean. We literally have a Samsung fridge right there in the kitchen.
I know, it leaves out some massive global players. Now look at State Street's SPDW. They use a broader index. It covers 24 developed countries, including Canada and South Korea. Because of that, it holds nearly 3,000 stocks. That's more than 3 times the coverage of Fidelity. And the fee? Even lower, 0.03%.
Okay, State Street came to play. Broader map, more stocks, cheaper fee. Let's see the 30-year test.
Here we go. Final $100,000. Fidelity's FSPSX. After 30 years, it grows to $1,442,116.
Not bad.
But State Street's SPDW pulls ahead from day 1. By year 30, it hits $1,962,452.
Oh, wow. That is, let me think, over $500,000 again. A $520,000 gap.
Yup, and SPDW pays nearly double the monthly income, too. More countries meant more opportunity, and that lower fee just sealed the deal. State Street takes the final round.
Okay, so the final score, State Street wins 3-2.
They do. Fidelity took the fee round and the total dividend value, but State Street won the big 3, S&P 500, total market, and international, the categories where long-term compounding does the heavy lifting.
It's kind of wild, right? If we just blindly picked Fidelity because they're famous for zero fees, we would have literally left hundreds of thousands of dollars on the table over our lifetime.
Exactly. When you add up State Street's 3 wins and subtract Fidelity's, State Street still comes out ahead by roughly $560,000 across the board.
$500,000. That's paying off the house. That's college tuition for the kids. That's kind of life-changing.
It really is. Now, Fidelity is still an incredible option if you absolutely want mutual funds or want to shave every single microcent off your fees. They're top tier. But if you want the strongest overall outcome, State Street delivered more where it mattered most.
Okay, but Frank, let's be real for a second. Most families watching this, including us a few years ago, do not have $100,000 just sitting around to drop into an index fund today.
True, which is why you don't need to start with $100,000. You can start with literally the price of a cup of coffee.
Oh, I like where this is going.
If you want to see exactly what happens when you invest just $1 a day into Fidelity index funds, click the video on the screen right now. We broke down the exact math, and the results, well, they might surprise you even more than today's video.
See you in the next one.